Good morning, everyone. We're from Group 1 and we're here to present about entrepreneurial finance. This is about what we understood from the assignment questions. So let's go one by one. First one will be Krisna.
And now we're going to move on into the first topic, that is difference between social entrepreneurship and traditional entrepreneurship. So, social entrepreneurship and traditional entrepreneurship differ primarily in their core objective. Social entrepreneurship focuses on creating a social value and solving societal problems through innovative solutions. The primary aim is to make a positive social or environmental impact, often while still pursuing financial sustainability through profit is not the main driver. Traditional entrepreneurship focuses on creating economic value and generating profit. Entrepreneurs in this domain are primarily concerned with building businesses that maximize returns for owners, investors, and shareholders. And we're going to move on into the next topic. Role of disruptive innovation in entrepreneurship in an established market. Disruptive innovation refers to the innovation that creates new market by discovering new categories of customers or drastically changing existing markets with simpler, more affordable, and accessible products. In entrepreneurship, disruptive innovation can be a powerful tool for entering and winning in established markets by doing things differently. An entrepreneur can use disruptive innovation by first identifying underserved segments in the market that established player may overlook. Second is simplifying the product or service to meet these new customers' needs at a lower cost or with a greater convenience. And third is scaling rapidly. Once the product gains traction, as the low-end disruption may eventually challenge incumbents in the broader market. By focusing on the overlooked customers and evolving the offering, entrepreneurs can grow and potentially replace existing market leaders. And that's all from me. We're going to move on into the next presenter.
Next topic is the Blue Ocean Strategy. What is the Blue Ocean Strategy? The Blue Ocean Strategy, developed by W. Chan Kim and Renee Mowbourne, encourages businesses to create blue oceans of uncontested market space, as opposed to competing in red oceans where competition is fierce and profits are reduced. There are three benefits, including reduced competition, increased customer value, and sustainable growth. Next slide, please. Next slide is about the importance of an entrepreneurial mindset in developing sustainable entrepreneurship. An entrepreneurial mindset is essential for developing sustainable entrepreneurship. It involves a unique combination of traits, attitudes, and behaviors that enables individuals to identify opportunities, take calculated risk, and create value in a sustainable manner.
Okay, thank you, Evan, for your explanation. Here we are on our next topic, is the role of venture capital in supporting entrepreneurship and the challenges. So venture capital plays a crucial role in supporting entrepreneurship, particularly in early stages of the business. High growth potential. By providing financial resources, mentorship, and industry connections, where VCs can help startups scale and achieve significant goal, where the external investor comes in to help the startup with their money and their mentorship and also the connection, where challenges faced by the venture capital investors, where the most one is exit liquidity. Exit liquidity is where the investor sells their share for cash when they want to exit the business after its growth. And these are the risks where the faced by the startup is risk, competition, measurement of interest, and regulatory environment. Okay, the next topic is bootstrapping. Bootstrapping is a very interesting concept. This is where the businesses use less or no external investment. It rely on personal savings or use the personal funding, or existing business uses cash flow to gain and achieve more achievements from the business. And we have a demonstration where the startups, this is the founders, they use their own personal capital or personal finance and also the business cash flow to organically grow the business. We're gonna go to next topic.
Okay, everyone, we'll be moving on to the second week of financial management concept. The first question is the role of entrepreneurial finance in sustainable business strategy. And he has a key role of guides long-term decisions on resource allocation, investment, and growth strategies. For such as examples, a startup may choose an eco-friendly suppliers despite higher costs, aiming for long-term sustainability and market differentiations. Next question is like impact of financial dynamics on entrepreneurial process stages. And start from idea stage, or funding is minimal but vital for research planning. And second is the launch stage, requires significant capital for product development and marketing. And lastly, the growth stage. Its focus shifts to managing the cash flow and the scaling efficiently. Next slide, please. Next question is following a startup without a stable revenues. Like start with an approach that you use methods like discounted cash flow or comparable company analysis. And they have some factors that consider market potential, intellectual property, and team strength. Next question is managing financial risk in a new business. And he has a risk mitigation like diversify revenue streams, maintain cash reserves, and insure assets. Such an example for a tech startup might use a convertible notes to limit dilution while raising funds. And next question is comparing funding sources for startups. And first is the angel investors. It offers a quick capital but may seek higher ownerships. And next is venture capital. Brings larger funds and expertise but reduces your controls. And next is crowdfunding. It offers flexibility but may lack investor experiences. Next slide, please. And the next question is that when to focus on long-term financings. And the timing is long-term financing is crucial for R&D, major investment, or even scaling efforts. And also the impact is it ensures stable cash flow and reduces the pressure of frequent repayments. And next question is benefits and the risks of venture capitals. It has the benefits to access to larger capitals, a mentorship, and even more networks. Next is the risk, loss of control, high expectation for returns, and the possible of misalignment of goals. Next question is bootstrapping, an entrepreneurial strategy. What it is? It's a growing to business using personal resources or revenues. And when do we use it? It's best for business with low initial costs or when maintaining control is the priority.
Okay, for the next one, there are two questions. The first one is managing liquidity in rapid growth. The first one is strategy. Monitoring working capital closely, optimize receivable and payables, and ensure flexible credit lines. The second one is concept. Balance cash flow and with outflows to avoid liquidity crisis. And the last question is exit strategy and in its impact in evaluation. The first one is IPO. Increase the company feasibility and valuation, but brings regulation burdens. And the next one is acquisitions. Offers immediate liquidity, but may limit the company's future directions. And then the last one is considerations. There are market conditions, financial performance, and investor expectation. Next slide, please. Okay, moving on to week 3, we have a case study here from PT Bintang Muda and Toko Tradisi. And this is the question and answers. The first question is the comparison of financial approaches. The first one is PT Bintang Muda, the startup. There are funding sources of angel investors and venture capital. And the next one is managerial decisions that focus on rapid growth, innovation, and market shares expansions. The last one is risk tolerance. The higher the risk of tolerance due to the nature of startup stage and to potential for significant returns. Next slide, please. Okay, the second question is the cash flow management for PT Bintang Muda. The first one is cost reduction, optimizing the market expenses, negotiate better deals with suppliers, and streamline operations. And then the next one is revenue accelerations, explore new revenue streams such as premium subscription or partnership with educational institutions. Next one is debt financing, consider the short-term loans or lines of credit to bridge cash flow gaps. Last one is investor relations. Maintain a strong relations with the investors to secure additional funding if needed, of course. And the third question is bootstrapping versus external funding for toko tradisi. There are two things here. The first one is risk of external funding, which consists of loss of control. Debt or equity financing can be dilute ownership to give investors a say in the company's direction. And the next one is increased financial obligations. Debt financing can lead to interest payment and repayment obligations. Second one is benefits of external funding. The first one is accelerated growth, access to capital fund, expansion, innovation, and market penetration. Last one is expert guidance. Investors can provide valuable advice and mentorship. For our recommendation, we recommend to give toko tradisi desire to expand and innovate. External funding, such as bank loans or targeted venture capital, could be beneficial. However, careful consideration should be given to the terms of funding and potential impact on ownership and control. Next slide, please. Two more questions. The fourth question is venture capital offers for PT Bintang Muda. It consists of the company control, evaluate the level of equity dilution and impact on the company's decision-making autonomy. And next is exit stage. Consider the VC's preferred exit strategy or IPO acquisition and align with the company's long-term goals. Next one is impact on visions. Assess how VC's investment philosophy and expectation may influence the company's strategic directions. Next question is international expansion for toko tradisi. 4 points here. The first one is financial planning. Develop a detailed financial plan including foreign exchange risk management strategies, pricing, and cost estimates. Next one is market research. Conduct through market research to understand local customer preferences, regulation, and competitive landscapes. Third one is legal and regulatory compliance. Ensure the compliance with international law and regulations related to business operations, taxation, and intellectual properties. Last one is partnership. Consider partnering with local distribution or agent to navigate the foreign market.
So the first question here, how to evaluate for PT Bintang Muda. The first is the appropriate valuation method. The most suitable method for a pre-revenue tech startup could be the venture capital method or VC method or the Berkus method. Second, there are factors to consider such as market potential, team experience, technology strength, and competitive landscape and investor expectations. The next question would be final risk management. First, we have to know the market certainty, like a hedge against foreign exchange risk, interest rate fluctuations, and commodity price volatility. And so next is internal factors. We have to implement robust internal controls, risk assessment procedures, and contingency planning. Now, as for the IPO preparation for the PT Bintang Muda, we have to prepare for the financial performance, such as improve profitability and demonstrate consistent revenue growth. Secondly, governance, establish strong corporate governance practices and comply with regulatory requirements. Followed by valuation, conduct a thorough valuation to determine a fair IPO price. Lastly, investors' relations. We have to build relations with potential investors and communicate effectively about the company's visions and prospects. Next slide. Next question would be the entrepreneurial finance principles. Now, first, we have working capital management. We have to optimize inventory levels, manage accounts, receivable and payable efficiently, and maintain adequate cash reserves. Leverage. We use debt judiciously to finance growth while maintaining a healthy debt to equity ratio. Next, liquidity management. We have to ensure sufficient liquidity to meet short-term obligations and seize opportunities. Now, lastly, the differences in the business scales. First, tax planning. Larger companies may have more complex tax structures and can benefit from specialized tax advice. Cost structure. Larger companies may have economies of scale and allowing them to negotiate better terms with suppliers and reduce costs. Lastly, it's technology investment. Larger companies may have more resources to invest in advanced technology and automation.
Okay, so after answering the questions on the case study, we can conclude two recommendations for these two companies. For PT Bintang Muda, we can recommend on focus on improving profitability, optimizing cash flow, and building a strong investor base. For Toko Tradisi, we can recommend consider carefully the benefits and risk of external funding before making a decision. If expanding internationally, prioritize market research, financial planning, and risk management.
Thank you everyone for your explanation, and thank you for listening. This is us, Group 1. This is the explanation about the case study and also the weak questions that we have understood. And this is our brief explanation about everything. Thank you so much.